Okay, so back in the day when Motorola was one of the leading semiconductor companies in the world, they would always start off their conference presentations with a slide that listed a bunch of issues that they called what keeps executives awake at night. So this is my current version of what Motorola perhaps would have drawn the list up had they been here today. It's different in substance from what they would have produced 10, 20, 30 years ago. But the question I want to ask you is that the detail may be different, but actually, are those issues still just a reflection of the times, or has something substantially changed that really makes it different this time? So, kind of the subtitle to my talk is, it's different this time, but with a question mark at the end of that to challenge you to say whether that really is the case. So how do we go about the work that we do? We're an industry analyst. We're not a financial analyst. We don't deal with stocks and shares and stuff like that. We look at the industry from the science right the way through to the end markets. And we try to base that on as much factual information as we can by looking at industry statistics, which may be good, bad, or indifferent, but the fact remains is they're usually consistent, so therefore you can analyze them. So the fourth major things that we look at is the economy, the unit demand, the fab capacity, and the average selling price. But then we have to look to see what is that data telling us. And depending on how good I feel, if I'm feeling down, I'm going to look at that data in a way that doesn't reflect its true meaning. If I'm feeling happy, I may overestimate the impact of that data. So you have to kind of drill down very forensically, very independently, to try to ask the question, what is that data actually telling me? And right now, we're very proud of actually what we seem to have been able to achieve over the last several years, at least certainly, because we were the only analysts to call that there was going to be a double-digit growth in 2018. We were the only analysts to say stop worrying when the COVID disaster hit in March, to say the industry was not collapsing, and of course it didn't. We were the only analysts to call the double-digit growth rate for this year, and the only analyst to call that there will be shortages this year as well. So we're very proud of that, actually. And why do we think we do it? It's because we've been looking at those fundamentals there and trying to analyze them. Now, on the downside, we are the only analysts to say there's going to be a downturn. Okay, and the jury's still out on that one there. And quite frankly, I hope this is one forecast I've got wrong, because I don't want there to be a downturn. I have lived through every single industry downturn except the very first one in 1960, and I know that they're not very nice. But I also know you survive the downturns because they make you better, they make you sharper, they really get your act together. And the companies that come out best from downturns are the ones that react fast and do the right things. So this upturn that we're currently experiencing actually broke in the middle of 2020. And it should have broken actually in 2018. And the only reason it didn't was because Mr. Trump, in his wisdom, introduced tariffs and trade barriers and restrictions on China, which nipped that market growth in the bud. So the fact remains is that pulled back demand, pulled back sales, and allowed us a little bit of breathing space. But all of the seeds were set for this current upturn actually back in 2018. They broke in July of 2020. And you can see here that Q2 dip when the market went negative. Very unusual for a second quarter, but the tremendously strong rebound in Q3. And it was that rebound that said the 2021 market was going to be at least 18% and with an upside of 24%. Every other analyst was in the 6 to 8% range. And we looked at that chart to compare that forecast with the others, and I thought, oh my God, I've really bet the company on this one. But I refused to change the forecast because we looked at that data, we looked at that momentum, and the only conclusion I could come with was it was going to just go out of control, which of course it did. Now, this is the 16th industry upturn. Okay, and people say to me, oh, this is a tremendous upturn, it's really strong. Well, I'm sorry, out of the 16 previous upturns, this comes in at a pathetic number 11 on the top list. Okay, there have been 10 other upturns that were stronger than the 26% growth that we've had this year. So it's not the strongest upturn. There have been upturns of 37%, 32%, much higher than the 26%. It comes in at number 11. Now, of course, it is a strong boom, and there's nothing wrong with 26% growth, but the fact remains is, please put it into perspective and don't start to make wrong conclusions about what does this upturn mean. The supply actually maxed out in the fourth quarter of 2020. That's when we first got into the situation, and that's why we said there's going to be shortages, because there's no way you're out of this box now. You're in this box, and you're going to have to live with it. So we didn't believe that COVID was actually the cause of this as such. The cause was the lack of investment in 2019, before COVID was even on people's minds. It was the lack of investment a year previously which caused the capacity shortage. COVID was the trigger which took us over the edge, but it wasn't actually the cause. The cause was the industry's fixation on profit versus security of supply. Everybody stopped investing in just in case, to put in security blankets, to put in inventory, put in protection. So what are those key driving influences, and what do? Well, the economy determines what people can afford to buy. The more dominant the economy, the stronger the demand. If the economy collapses, it always takes the chip market with it. There's never been a case where the economy, a chip market, has been strong in a weak economic situation. In terms of the unit demand reflects what users actually buy, but that may not be what they want. So you cannot automatically correlate demand in terms of production with units that you're buying, because there's an inventory adjustment there. There's an adjustment for lead time extension. If the lead time goes from 4 weeks to 40 weeks, you've got to buy extra product there to keep your product lines going. The capacity determines what you can make, and that's always under or over. It is never balanced. It is impossible to balance. So you're always in an undersupply situation or an oversupply situation. And the ASP is what you get for that part there. Now, that is not necessarily a value proposition. It's really a very much sold on a cost per square centimeter basis. And the average has been very remarkably consistent over a period of time. You need to track those, we believe, against what the current situation is versus that long-term trend, because those long-term trends have been remarkably predictable and remarkably consistent. So when we get these forecasts right, it's not because we're smart, because we're better. It's because we look at those trends and see, are we deviating from the trend? And if you're above or below the trend, then there's going to be a correction. Or the trend has changed. And if the trend has changed, I would ask you to tell me why the trend has changed, because it doesn't just change because you want it to change. It changes because something has fundamentally happened. Now, our outlook. I don't want to pour rain on your nice party here, but this next couple of slides aren't very pleasant. Okay? And they're not very pleasant because it's how we see the fact here. The 4 key driving influences. The economy is a very toxic mix of slowing demand because of the inflation pressures, because of fuel prices, because of food prices, because of all those things in here, really slowing down consumer spending and discretionary spending. And now we've got the recession word coming into the equation now, where people are starting to talk about the risk of an economic recession. So we've seen all of these issues here, and they're now starting to come to a head. The unit demand is running well above the long-term average. Now, we're currently running at a run rate of 8 billion units per month. The trend line says it should be closer to 6.5 billion units per month. Now, where is this extra unit demand coming from? It's going into inventory. It's going into filling up the supply chain. There's a whole bunch of issues out there. And the fact remains is that we're running seriously above that trend line. In terms of capacity, we're seeing here, we're still in a very shortage supply, but we have seen an incredible boost in CapEx spending. After years where the CapEx has been very, very benign, we're now seeing last year CapEx grew by 45%. The market only grew 26%. So we're spending way above what the market determined what we should be spending on CapEx. 45% growth, $100 billion. That's 20% of sales almost. So it's a huge number, well above the long-term trend line. It is going to bite us. It's going to bite us hard because that money has been spent. That means it's been bought on equipment. That means it's being installed. That means it will produce wafers. And that will take the capacity into an oversupply situation. And the problem with that spend is we're targeting an overinflated unit demand. So we're trying to aim capacity for that 8.8 billion units a month. We should only be aiming the new capacity at 6.5 billion units per month. So we're really building ourselves into a problem. And that always happens. Now, the ASPs are on a sharp upward drive. You can see that there, and they're rising. They're up 35% over a year ago. And that's incredibly high. Now, ASPs, the long-term growth in ASPs is 0. Okay? So for every complex chip you make, you price reduce another one. The long-term trend is 0. And it's something which I observed myself a little while ago, and I was very happy to see Wally Rines told me that Gordon Moore actually produced a slide on that. It's kind of called his second law, which no one really talks much about. But he observed that the average selling price trended to $1. And we drew a chart which showed that as well. The fact remains is when you look at the long-term growth rate of ASPs, if you're growing 30%, it's going to fall down 30% at some time to get that back on track. We're in the third year of growth, and that's always dangerous. We've got CapEx booming, and we've got demand worsening economy. The years of plenty dull the senses. We get obsessed by the party. We get overwhelmed. We stop looking at the reality in there. And our radar kind of gets fallen into disreduce. We're not really looking at what's happening ahead there in the same way. And all of those 4 influencing factors there are in trouble. And to make matters worse, when you plot the quarterly growth trends against the yearly growth trends, those curves crossed in March 2022. We are now in the territory of stormy weather ahead. So every statistic you look at is telling me we are heading for troubled waters. And it looks to me like there's going to be a potential double whammy here with a capacity boom just as the market is slowing down. That is one of the worst possible combinations you could ever want to have. Any one of those 4 things slowing down there would be causing you a problem. When all 4 happen together and you get a capacity boom coming on stream with diminishing demand, slowing down, it only has to slow down. That's all it has to do is just slow down a little bit, and that will trigger you into a major overcapacity situation. We did this chart here at the end of the dotcom bubble boom. So I was interested to see what the hell happened to this here. And we plotted what happened to the unit growth, and we plotted what happened when it fell off a cliff. Demand rises, lead time extend, buyers order more. Stock to cover that delay in the lead time. They order just in case. Lead times extend many more because the demand is overinflated. Suppliers struggle to meet demand, and you get into a serious undersupply situation. The capacity maxes out. Additional capacity eventually is added, but only after about 3 quarters worth of delay before people really wake up to the fact that, yeah, we've got to build new factories. And so you leave it till it's too late, and then, of course, the problem's even worse. And you're now targeting an overinflated level of demand. The capacity will then overshoot, and that immediately causes a contraction of lead time. That immediately causes a liquidation of inventory. And if you've got 40 weeks lead time, you go back down to 4, you have 36 weeks worth of inventory that you have already bought. That means you don't have to buy anything for 9 months because you've already bought it. So I don't care how many long-term agreements you have in place. I don't know what other precautions you think you've got in place. They won't really work up. If the customer doesn't want the parts, you can force him to take them. You can enforce the long-term agreement, but he still doesn't want them. He still doesn't need them because he's already bought them. So all you would do if you really did enforce that was to push the problem down the road and just make it become even more dangerous because eventually it has to adjust itself. So, you've got to work on the basis of the fact that at the end of the day, you have to realize and react to what the customer actually needs. Once supply catches up with demand, it will implode. There are no soft landings. There has never been a soft landing in the 60 years of the industry. If we have a soft landing this time around, it would be the first time in 60 years. Now, I'm not a betting man. But I would bet that that isn't going to happen, okay? It will crash, and it will crash because the unit demand dries up. It will crash because order books get evaporated. It will crash because you've already bought the products there. You don't need to buy it. And what happens when the unit demand crashes and you wake up one morning and you're facing an empty order book? The first thing you do is bomb the price. Any order is a good order, okay? So the price drops, that ASP will plummet within weeks. And that's what always has happened. If it doesn't happen this time, as I say, it'll be the first time in the industry's history. Our forecast for this year is 6%. We reduced it from 10% a few weeks ago because we believe that the second half is now much softer than we thought it would have been when we did the forecast in January. But I don't care about this year's number because this year's number is irrelevant. What I'm worried about is next year's number, because that's the one that's really going to hurt us, because this year is what it is. It's just momentum. And the only difference between 6% and 10% is the timing of when the whole thing kind of falls into disarray. So this is the 17th down cycle. The fuse is already lit. It's burning. It's going to blow up. It's just a matter of seeing it through to that equation there. And, you know, when you look at it, the same trigger has always been the case. It's always been a mismatch of supply and demand. So it's different this time. Well, I guess you've probably understood now my message is I don't think it is, don't bet on it, because I think you'll find the similarities are remarkably the same. So I just went back into my files and pulled back some charts that we produced over the years. And this one is fundamental to our silicon chip workshop training session. It explains that the real reason why you have this supply and demand imbalance is simply the mismatch between the supply and the demand. Supply is on a 2-year minimum lead time, and demand can vary very quickly. You can't balance those two together. So you're always going to have this mismatch. The economists call it the hog cycle or the pig cycle, and it's just very well understood. And it's that drives the industry. When you look now at the difference between the boom year and the down year, and this is a chart here, again, we did this in 2007. You find the change between the growth year and the next down year is typically anywhere from 30 to 70% change. So you go from plus 40% to minus 30% in the space of 1 year. So when I say that we're looking at this year a growth of 20, last year, or even this year, 6% growth down to minus 22% for next year, which is our forecast for next year, minus 22%. It's going to go negative. Always does. That's only a 30% difference, 28% difference. That's quite benign. We've seen changes much bigger than that. And I looked at then, I didn't change these charts, but if I looked at what's happened in the previous 10 years after that chart was made, it's exactly the same balance. These 30%, 40% changes in there. So history will tell you that when you do get a disruption, when you do hit the rocks, it happens to be very dramatic, and you will get these big double-digit changes in growth rate. This was the analysis behind that little sawtooth chart you saw there, and that just explained the math behind that. And this is the other chart here where people say, yeah, but it's different this time. The industry is more diverse. It's more geographically in nature. We've got all these new markets coming into place here. It's always been that way. We had exactly the same chart in 2007 where we wrote down there all of the reasons why it was going to be different that time around. And it wasn't. And it was the same because the same mechanisms are always driving it. So the arguments that are put forward now about why it's different this time, the diversity, geographical, the new markets and stuff like that, that's what the industry does. It creates new markets constantly. It's always reinventing new markets in there, and when it stops that, that's when you've got a problem there, and it's not stopping that at all. So my message is, be smart, be prepared. It's going to happen. The sooner you have a plan to react against that, the better it is. And this Polish philosopher came out with this little saying about the early 1900s. He was talking about revolutions, which were pretty commonplace in Europe at that time. And his observation was, before a revolution happens, it seemed to be impossible. After it's happened, everybody says, well, that was inevitable, wasn't it? Well, my advice to you is just change revolution for semiconductor market crash, okay? Right now, everybody tells me it's not going to happen. I guarantee you, one day after it happens, well, it was inevitable, wasn't it, really? You know, I mean, blah, blah, blah. Don't lose track of the industry fundamentals. If you're an IDM, $9 a square centimeter. If you're an IP provider, 10 cents per square centimeter. That is your budget. You're not going to get higher than that. Those are constraints which have been with the industry since data records were collected. It's the average, so different companies work around those borderlines there. But you're not going to change it very much. So please, 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 Keep track of those fundamentals. Keep online with them. See what they're doing. See how deviating you are from those fundamentals. Because if you don't keep track of those differences, you're likely to fall into problems. So when you're in a market boom, plan for it to end tomorrow. And when you're in a market bust, by the way, plan for it to end today. Because the sooner you react up and down, the less pain you'll have to feel. Thank you.